on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. On Sky News Business, this is Equity Investor with Julia Lee.
Welcome to this special edition of Equity Investor, straight from the Australian Stockbrokers Awards. Today's a very special night because it's the 25th anniversary where the industry comes together to celebrate the industry's best and also raise funds for charity. We have a very special night for you planned with some of the finalists for the Stock Pickers category tonight as well. But let me introduce our panelists for the first section of the show. We have Andrew Tracy from JBWE, Kanish from ETF Securities, and Chris Conway from Australian Stock Report. Thank you so much for joining me, and lovely to see the touch of gold, which is the theme for our night tonight. Just starting off with the market, we'll have to celebrate that the Australian share market has reached a fresh GFC high, a fresh 10-year high. I mean, stocks like Macquarie Group, ASX, SEEK, Qantas, Webjet, all hitting fresh highs. I guess the big question is, what's your outlook for the market? Should investors be piling in now, or is it time to be a little bit more cautious? What do you think, Andrew?
Geez, it's not unusual for the Australian share market to do a bit of window dressing pre-June 30, is it? But it has been very strong. At the moment, it's trading above our year-end valuations, and we're underweight Australian equities as we stand. We actually think we're a late cycle in this rally, so going massively overweight equities in the Australian sense might be a little bit in the wrong direction in our opinion. We're actually overweight the US equity market, and with a focus on the IT side. And you're starting to see some of the major economies, Europe last year, US this year, hitting peak GDP and rolling over, and Australia will do the same next year. So underweight Aussie equities, but remotely cautious.
Okay, it's an interesting view because, Kanish, when we have a look at the global growth environment, it's certainly been US that's been driving the momentum in the global equity markets. But I guess looking at your portfolio, do you gain access to those economies that are later cycle like the US, or do you try and have a look at some of those economies that might not be there yet? What sort of diversification are you doing, and how are you allocating assets?
So I think for us, where we're seeing a lot of flows actually into safe haven assets more recently, the past 12 months, has been things like physical gold, where clients are starting to see, with potential trade wars, geopolitical risk around the North Korea-US summit, and also a Trump tweet here and there that could potentially move markets. How do you protect your portfolios? And I think something clients need to consider is diversification, not just into, say, the broader US market, but Europe, Asia, but also other asset classes like commodities.
Now, Chris, you're a finalist for the Stock Pickers category, so I'm interested to hear your view. It does sound like investors are a little bit cautious given the strong rise that we've seen. But if you go back in history, periods like this tend to extend for longer periods of time, and generally the market reaching new highs is a sign of strength. What's your view? Are you piling in or piling out?
I wouldn't say I'm piling in, but I'm certainly probably more bullish than bearish, and that's because I come from the perspective of being more a trader than an investor. And so when you, like you say, when there are these periods of momentum, your goal as a trader is just to ride them until the market tells you that there's no further reason to ride it. So I'm happy to be long at the moment. I wouldn't say I'm all in, but I think it can go further.
Okay, so I'm interested, Chris, given that this is an equity investor show and we do love our stock tips, what stock do you like at the moment?
You mentioned it earlier, Qantas. That's our pick at the moment. It has broken higher, as you said. It got above 650, which was a previous resistance. It has been doing everything right recently, both from a technical perspective, but also it's gone from being a turnaround story a few years back to now just a great company that has growing revenue and profits. So we like the fundamentals, and there's a few catalysts on the horizon as well, potentially the dividend reinstatement, which would be after 10 years of not paying dividends. So that could attract a different type of investor to it, and possibly an earnings beat when they drop numbers in August. So I think there's a couple of catalysts which could really drive the stock price higher.
Okay, so Qantas hitting an all-time record high today, and Chris still liking the stock. I mean, Kanish, the ETF space is an interesting one because there are so many products now, from the smart beta products to to the index-hugging ones. What's your favourite?
So favourite for us is our ETF series, Global Technology ETF, TECH, TECH. And I think it's been one just on performance. Just 12 months at the end of last week had returns of 37%. Over 12 months, we're seeing, as Andrew mentioned earlier, looking at the tech sector, it's had significant growth over the past few months. And taking the exposure via an ETF, via a basket of stocks, so not having to take it via a single stock risk, and having to access offshore exposure, whether it's been through Apple, Google, Facebook, you can do that via that ETF there. It gives you exposure to the established names of Microsoft, Facebook, Apple, etc.
I might invite Andrew and Chris in on this conversation, because there's no doubt that the tech sector over in the US has been absolutely booming in 2018. For those Australians who are perhaps underweight this sector, is it too late? You're seeing, stock price performances of perhaps 200, 300% by some of these stocks here in Australia. Chris, what do you think?
It is a very good question, and we might touch on it more when we talk about Appen, but even local tech companies have really enjoyed, a stellar growth in the share price and obviously in revenues and whatnot as well. I don't think it's too late, and that's because of disruption, and disruption is going to continue in our economy and for all of our companies. So I think, if you're not in yet, you still can get on board.
Andrew, we have seen disruption before, whether it's in the agricultural space, the industrial space, and now it's in the internet and technology space. Does that mean that, traditional valuation methods no longer relevant? What's your view?
No, I wouldn't go that far. Traditional valuation methods will hold up during this boom as they have in previous booms. I think we had the same conversation back in 2000, the tech boom and bust. Those valuation models will come to the fore when markets get a little bit rocky. I think our ETF colleagues, if they want some advice from me, I think a legal and compliance ETF would be fantastic. It's got to become upgrade post the Royal Commission, and I think we could all make some money out of that, given all the paperwork we're doing.
So a bull on the compliance area in finance. It is time for a viewer email. So let's go to this email from Ian. And Ian asked, what are your views on Appen? The stock has been now included in the ASX 200 index, and the stock has risen very strongly, continues to rise again today. Is it time to keep on piling in, or is it time to get out? Andrew, what do you think? Well,
it's up 7% today, so it's had a record run. I think if you go back to their result in February, they beat expectations. We did a very good piece in December last year from our investment strategy group. It's a group of 20 individuals inside JB Weir, and artificial intelligence is one of the key themes we're running within JB Weir. So this Appen fits right square into the middle of that. There's only three ones that we want to have in the Australian market: Altium, Appen, and also NextDC. You've mentioned half a dozen of the international ones. All those who either have hardware that they produce to operate this artificial intelligence, or that have the platforms where that data is collected for those particular artificial intelligence programs. They're the two keys that you want to be exposed to, and Appen's definitely there.
So for those of our viewers who aren't aware of Appen, this is a tech stock which specialises in language, and obviously as the world becomes more global, we need some language translation, and mostly for enterprises as well as for governments. And Chris, looking at a company like Appen, I guess one of the things I notice is that 5 of its top customers contribute to 80% of revenue. So there's a huge single customer risk here. So we always look at the upside. What are some of the risks involved? Do you still like Appen at this stage?
Yeah, look, just to your point, you're exactly right. They have very big clients that obviously that generates a lot of revenue for them, and if one of those falls over, it could create a big revenue hole. Now, the great thing is about this company, they're operating in that language space. 50% of the world's population doesn't yet use the internet, and it's mainly in non-English speaking countries. So as those countries adopt the internet, they actually have quite a big growth platform. So from that perspective, I like it, but in direct answer to, I think it was Ian's question, do I pile in or do I take profits? I would say neither. I'd just wrap my trading head around it and say, just have a nice trailing stop in there and keep riding it, and if it bumps you off, well, then it bumps you off.
Okay, so hold on and ride the momentum higher. I mean, Kanish, looking at Appen, this is a stock that's up 270% over the past year, and having a look at some of the numbers there, earnings before interest, tax, depreciation, and amortization, expecting to see between 50 to 55 million, but a market cap of 1.4 billion. Looking at a stock like this, I mean, is this typical of its international type of peers? What do you think of Appen?
Yeah, I think for us, so we actually launched a robo ETF. It's an ETF that looks at this thematic, robotics, automation, artificial intelligence. So Appen is one of those stocks that potentially could feature in the portfolio. Currently, there are no Australian names in there. And, when we're looking at this idea, robotics and automation, artificial intelligence, it's continually growing. In robotics, we're only seeing penetration really in manufacturing and the automotive industry. So there's still a lot of growth to be had in things like consumer and in healthcare. And on the processing side, there's a lot that's going to be starting to happen. And a lot of companies, established companies like John Deere, are reinventing themselves to be tech names. And I think that's where, for me, to Ian's question, stay in, sell out, I would actually say, well, think about how if you're thinking about that theme, look at potential other avenues to get exposed to that theme, things like that robo ETF or potentially other sort of exposed like tech.
Can I put you on the spot and ask you sort of the difference in the performance over the past year between the tech ETF and the robo ETF?
Yeah, so more recently, in the past 6 to 8 weeks, a lot of that performance from the tech sector and specifically our robo ETF, which is the thematic, it looks across sectors, looks across region, has been driven by the tech outperformance, has been driven by the US. So a lot of the US names and the software names has driven a lot of that outperformance more recently. I think the robotics and automation industry, they've hit sort of record earnings in the recent quarter, Q1 earnings report that's just come out for that particular index. So I think you're going to still see significant growth, and it's just about how to diversify away from the home bias, away from companies like Appen.
Okay, we've got around about a minute before we need to go to commercial break, so I might just open it up. For the financial year to date, the Australian market's up around about 8%. We're tracking pretty well, and we're counting down till the end of financial year. Most sectors double-digit gains, except for those defensive sectors like utilities, telecom, and the property space. But the best has been energy, up by about 35%, healthcare around about the same. If you had to pick a sector for the next 6 months, what would it be, Chris?
I'm still an oil bull, so I'll stick with energy.
Energy.
I think oil prints somewhere in the 80s in the back half of this year.
Wow. Yeah. So think that oil prices are going to go up, and yet your favourite stock pick is Qantas.
Yeah, it doesn't make sense, does it? Doesn't quite marry.
Well, Qantas does a good hedging program.
They certainly do, yeah.
Hedged away a lot of that risk in the next couple of years. Kanish, what about you?
I think for us it would be tech. I think definitely, and global tech at that as well.
Okay, and how about you, Andrew?
I think there's going to be increased volatility in the second half. It all comes down to inflation as well. If inflation starts to get out of the bottle, we'll start to see the Fed chasing their tail. That'll put a bit of a shudder through equity markets, but at the moment on the base case, we'll probably be overweight resources.
Okay. Love getting the variety of opinions, and thank you so much for a great session. Congratulations on a great financial year, and please enjoy your night. Please join me in thanking our guests tonight, Andrew Tracy from JB Weir, Kanesh Kura from ETF Securities, and also Chris Conway from Australian Stock Report. We need to go to a break, but please stay with us.
You're watching Equity Investor on Sky News Business.
Welcome back to this special edition of Equity Investor, straight from the Stockbrokers Awards. Behind me, you'll start to see the crowds trickle in as we celebrate the industry's best and raise funds for charity tonight. Let me introduce our panellists for this second section of the show. We're very lucky to have Stephen Emmerich from Belvedere Share Managers and also Peter Harper from Beta Shares. Welcome to the show. Should be a great night, but before the festivities get a little bit more rowdy and carried away, I want to ask you about some stock tips. And Peter, especially for you in the exchange traded product space, there's been so many products. I'm curious, what's your favourite one? Do you have one?
Look, I've probably got a lot of favourites, Julia, but one that stands out to me at the moment is probably the cybersecurity ETF. One of the interesting things we've seen last year was cybersecurity attacks hit a record high. There are actually about 54% of US companies had a successful cyber attack against them. So that really shows the extent of this growing problem. And the more our lives go online, the more we become prone to cyber attack. So if you talk about the ways our lives are going online now, we've obviously got mobile phones, cloud computing, robotics, driverless cars. All of these factors rely on cyber security in order to protect their infrastructure. And so to me, it seems like a really nice way to play that overarching theme, and you can do that through the Hack ETF.
Okay, so I'm curious, the Hack ETF, I'm guessing would be a US-centric ETF. What type of companies are in it, and what's the performance of something like that compared to just a pure technology type of exchange-traded fund?
Sure. It's performed very well. It's actually the best performing technology ETF in Australia over this year to date. It's up about 25% over the first 6 months of the year. And the sort of exposure you get, it's actually a global exposure. The biggest 30 cybersecurity companies in the world, talking your Cisco's, your VMware's, Palo Alto Networks, those sorts of companies. And whilst it is global, a lot of those businesses tend to be US based, so it does tend to have a fairly strong US centric exposure. I think one of the interesting things about this is that you're looking at revenue growth in the top 10 companies sitting at about 22% average over the last 3 years. And that compares to about 15% for the broader technology industry, which is already a good number. So that probably highlights some of the opportunity that we see in that sort of exposure.
Stephen, I might bring you into this conversation. For Australian investors, the internet technology space or the information technology sector is the smallest area on the Australian share market. So when you look at your client base, are you underweight technology, or do you go over to the US or use ETFs? How do you manage exposure to the technology space, given our industry is so small here in Australia?
We've actually got quite a substantial exposure to Hack as well, so I'm like nodding away, everything. Obviously we use Hack because there's some of these smaller tech companies, to really understand them can be challenging because they're quite technical. So you've got then trying to understand the true risk of the company can be tough. So if you use something like an ETF, then you've got the diversification, you're still getting exposure to the sector, and that the revenue increases and the demand increase of that space, but without having to specifically take on exactly what's happening in each of those individual stocks.
Fantastic. I mean, Stephen, your stock tip now. Favourite stock on the Australian market today, 10-year high for the market, WiseTech, Altium, Seek, NextDC, Qantas, ASX, Macquarie, they all reach all-time record highs. What do you like?
Right now, I like a company called AMA Group, or it's they're an automotive-based company, so they had a panel business, which is a series of panel shops, and they've also got another business which sells four-wheel drive products, parts, trays for utes. And now, the reason why I like it is at the moment they're looking at a demerger, so the panel shop business is being bought by a private equity firm, and then the remaining business will be segregated off, which will just be the parts and the automotive accessories. But from a valuation perspective, it just makes sense. So currently, the stock's trading at around 96, 97 cents. The Blackstone proposal to buy the panel shops is for an 86-cent cash payment, and then the other business has been sort of valued by the management and the investment bankers at sort of 30, 35 cents. So you can buy a company for 96 cents, get 86 back in cash, and then have another business here that owes you 10 cents and it's sort of worth 30 cents. And the guy that runs it, great story, dropped out at, so Ray Malone dropped out of high school in year 9, went and did a panel beating apprenticeship, started build up his own panel shops. He then sold those panel shops into a roll-up, which was AMA. Now, at the time, he wasn't running the company. He was just a major shareholder and working in the businesses. They didn't do a great job. The company went through some really tough times. Ray stepped in, booted half the board, and then turned it around, fixed the debt problem, and turned it from a $12.5 million business into a $500 million business. So he's got what it takes to make it work. So realistically, for me, I'm happy to back the business now just because he's at the helm.
Wow, what a great story. So AMA is the stock code there. Just moving now to the general market, and 10-year high for the Aussie share market. Great to see, but we've really started to see a divergence between the performance of the Australian market versus some of the other developed markets around the world. Just looking from a strategic point of view, how would you be positioning portfolios? Where should be overweight, underweight?
What we're looking at the moment, Julia, is I think we're still fairly positive on growth in markets at this point, but perhaps a little more cautious than we were is probably the overall position. So one of the ways we would look at to play that sort of view is still to remain long growth assets, but to try and look for some of the things that are trading a little earlier in their recovery cycle, I suppose, and perhaps on slightly lower PEs. So in a regional sense, looking at those markets, Australia would probably qualify as one of those markets that might be on a slightly lower PE, but Japan and Europe stand out. If you put Europe's political problems aside, which by and large I think will probably clear themselves over time, valuations and earnings growth still look relatively competitive there. Another area moving outside of global regions might be something like, for example, global energy companies. So you can access, look at global energy companies, they're fairly under-owned relative to where they've been in history, trading on lower PEs than they have historically. That looks like another interesting area to me, and you can access all of those through ETFs, HEUR for Europe, HJPN for Japan, and Fuel for energy companies.
Wow, lots of ideas there. Stephen, I guess just in relation to what Peter said, do you agree, or what's your view on sort of portfolio allocation at the moment?
Well, I agree that the market is a little nervous from time to time, and probably because we're sort of trading at highs, historical highs. But we're just trying to look for businesses that have got management, good management. We're really trying to back the people that run the businesses and understand that at the end of the day, when the lights turn off and everyone goes home, it's just a building. So they're the people that make them what they are. And we're also trying to maintain some exposure to the US economy. The building and construction sector over there is performing really well. And just trying to focus on diversifying the portfolio, trying to get exposure to those sectors that have got tailwinds in quality companies, and trying not to be jump at shadows. If things go wrong from time to time, it's to be expected, but we don't want to overreact and make the wrong call.
So volatility could be an opportunity in 2018. It is now time for a viewer email, and this is an interesting one. This viewer is asking about Credit Corp, saying that recently Credit Corp has seen some pretty strong results over in the US, even though Australia has been a little bit more subdued. But why the weakness in terms of the share price? I had a look at the share price. The shares were trading over $20 at the beginning of the year, $18, and now in a trading halt. So looking at this company, I did see a few media reports today. It looks like a short seller's report has come out. Stephen, what do you think about Credit Corp?
If you had have asked me this question last night, I would have said it doesn't look like bad value. Was trading at about 10 times EV/EBITDA. The business has been around for a long time. They know what they're doing as far as buying debt ledgers and collecting on them. And then this morning, trading halt. And I've read through the report, and this short seller's made some pretty big accusations. They've taken a real swing at the management, and unfortunately now I sort of look at it and think, okay, well, we've had a few of these events through the year, Quinnus and Blue Sky, and in both those scenarios, the short sellers tend out to be right. So it's a nerve-wracking experience.
So for investors who are caught up in the short-selling frenzy or a potential report that comes out, what do you do, Pete?
Look, Julia, we're believers that there's definitely a place for both active and passive management in portfolios. In terms of looking at that area of the market, that's an area where we would generally try and take a more diversified sort of exposure. Something like our X20 ETF would hold stocks 21 to 200. But with that added diversification, it helps you avoid any pitfalls in individual companies. And yet you can still access earnings growth that's looking at about 11.5% EPS growth on a one-year forward basis in the X20, as opposed to only about 3.5% EPS growth in the top 20. So we would probably, as a business, try and go more diversified in that sense, but obviously respect everyone's right to do as they choose.
You've probably heard the noise levels rising here. It's setting up to be a great night for the industry. Hopefully we're raising lots of money for charities and celebrating our industry's best. Thank you so much for our panellists tonight in this special show of Equity Investor, straight from the Australian Stockbrokers Awards.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. You're watching Sky News.